Well, hello everyone. Don Garman here again. Here we are, October 2024. The Q3 has officially ended yesterday, and unfortunately, for the first part of this video, I'm going to start it with a bit of a good news, bad news setup. The good news is we had a productive quarter. Q3 was kind to the strategies, gratefully, and so we end yesterday at new highs, which I'm sure everyone will enjoy briefly because we open up today to new heightened tensions in the Middle East, unfortunately. And so that obviously brings with it a fair amount of consternation, in addition to which we have a presidential election in about 35 days, which couldn't, the choices couldn't be more different in terms of what we will wake up to on November 6th, in terms of what happens next. So the positioning of the core strategy, which many of you have owned for many years, will remain, I would say, skewed toward defensive, certainly for the next few weeks, as we don't need or aren't in a position to have to take an unusual amount of binary risk on the outcome of the election or any other such thing. So we will do what we always do, which is, particularly in that strategy, err on the side of caution and kind of push through the election and into the setup. This is where the good news begins. And after this, I will get to introducing this handsome gentleman over here. But the good news for those of you who have a longer time horizon, as many of us do, is that for the first time in a long time, there are counted about 75 companies in the lower half of the market cap measurement size, is what I'm referring to, of the S&P 500, are projecting earnings growth in the next 12 months of over 20%. Actually, it's 25%. So what does that mean? So what it means is that the setup, as I've been kind of alluding to for some time, is that just the law of large numbers would suggest at some point the largest companies that have certainly represented the majority of the math behind the move in the large indexes may be handing over leadership to a different cohort of companies. And this would coincide with what happens, down the road after a rate cutting cycle begins, because a lot of those companies do use debt as a tool, and as their costs on the debt side improve, their earnings can also improve, which has been very supportive of the type of work we do and have done for 3 decades. So I think we have a great setup going forward. I would anticipate that maybe, as I did a year ago at the end of October, announcing the reduction of some defense in favor of a more broader offense in terms of our style, I suspect we might be doing the same a month from now. So time will tell. We're obviously a little nervous at how things have evolved in the Middle East. That has many negative implications, and we will all just keep our fingers crossed that cooler heads prevail and that they can somehow push this back from the brink and into something more productive. So without further ado, I want to introduce Jackson Vickers, who's there. I think I pointed the right way. So Jackson, say hi.
Good morning. Hello.
So what I wanted to do this morning is, Jackson's been with us for over a year now, and we've worked really side by side for the entire year on many important initiatives. And Jackson's led the way, I would say, in advancing some projects that will continue to build our capabilities. So as we look forward over the next 3 or 10 years of what our clients are going to need, one of the key things that we wanted to do in bringing him in was be able to deliver proactively and actually strategically and in a targeted fashion financial planning to all of our clients. So Jackson, do you want to say hi, and then I'll get into the next thing I wanted to discuss with you? So why don't you introduce yourself and then talk about the sort of financial planning all the way through the estate planning capabilities that we now have that we didn't have a year ago. So thank you.
Yeah, absolutely. Well, good morning. Thank you for the introduction. I'm excited to be here. So In the past 12 months, we've really ramped up our capacity in financial planning and then wealth planning, retirement planning, estate planning, the whole process. I kind of like to think of it as the construction of a home, and you need the foundation and the buttresses, the girders, etc. And so we'll take your cornerstones, your goals, we'll help you identify those, track your cash flows, plan for your retirement, manage your portfolios. We can address tax concerns, borrowing costs, all the way through introductory level and basic estate planning. Obviously, that's going to depend on your scenario, but we can offer that as well. So our capacity is really, and our capabilities as well, have really ramped up in the past 12 months.
Excellent. Yeah. And so I would comment, because many of you will, that Jackson may look young, and in fact, he is young, but I can say this categorically, he is wise beyond his years and is at least 15 years ahead of where I was in terms of I couldn't have the conversations I hear him have all the time today until I was maybe in my 30s at some point. So kudos to him for that. Dovetails into piece two. So as you know, we have a good, durable capability in, obviously, we talked about financial planning, but the investment management piece is where we have separated ourselves in terms of how we do it relative to other people do it. And we've done it very effectively for the group of people that we serve. What we have built out or have begun the process of building out is many of you have asked for and will need things that aren't necessarily just public equities or public fixed income or the type of investments that are fairly common, and I don't want to use the word mundane, but in order to enhance returns, it's beneficial and has been beneficial sometimes to forego some liquidity in pursuit of higher returns for a portion of our portfolio. So Jackson, do you want to comment on that, what I'm sort of poorly cryptically describing and what we're building out?
I would love to make a comment there. So I think the opportunity in private market alternative investments is incredibly unique right now. And Don, you've done a ton of due diligence on this for our clients. And I think the way that I would tie it into financial planning is obviously with the lack of liquidity there. So liquidity is going to be the largest concern for private market alternative investors. And so that's why an appropriate and comprehensive financial plan is crucial, so we can identify how much liquidity you need, and then we can lower your volatility and increase your returns on a risk-adjusted basis by allocating to private market alternatives.
Yeah, that's well said. And to add to that, and I think for the purpose of this video, we can leave it here because you will be coming on probably more often in the future, certainly than the last year. All of our public equity portfolios have grown. Our needs have changed from what they were 5 or 10 years ago, and considering adding some piece of alternatives will address the scenario where if the Fed is going to lower interest rates back to the low 3s and cash returns are back to the high 2s and bond yields are in the 3s and 4s, that's going to create a problem for a lot of people who need and are in a position to need more income than that from their portfolios. So we're getting ahead of this in the sense that the Fed has just eased once. More than likely, they will continue down that path. We need to start to have those conversations today about how to lock in higher yields for those of you who need it. So those conversations will be coming. So thank you, Jackson. Thank you for all you've done. You've done a wonderful job in your first year, and you get better every day, which is all I can ever ask. And so Jackson, why don't we leave it there? And for those of you who watch these, thank you very much. Thank you for the trust, and we will look forward to checking in with you in November, if not sooner. All right. Cheers, everybody.
Thank you again.